Hey everybody, it's Pete. Good morning. Today we're going to talk about the three most common order types when you're buying and selling stocks that you absolutely need to know. And I think what's the most important thing here is most traders don't know they all exist and actually don't capitalize on them. There are so many opportunities where you can place orders in the market before the price even gets there to make sure that you get into the trade, to make sure that you start a position, to make sure you exit a position exactly where you want. And what's interesting, I'm not just talking about exiting position to get out for a loss. Like most people understand what a stop loss is, but you can also use those same types of trades to get into a position well before the price even gets there. So you can place the order now, and then if the price trades to that area, you get into the order, and you don't even have to be sitting at your screen while it happens, which is kind of fun actually. But more importantly, it means you're prepared. You're willing to say, that's the price I want to get in, and unless I get my price, I'm not going to get involved. And that's actually good trading. If you find these videos helpful, definitely click down and subscribe. I'd really appreciate it. If you have any comments about what we're about to discuss, definitely leave them below the video. I'll get back to you as soon as I can. So what we're going to talk about today is we're going to talk about the market order. We're going to talk about a limit order. And then we're going to talk about what's known as a stop order, which actually has both a limit order and a market order. Okay. We're actually going to head over to the screen and we're going to demonstrate using Roku how to use all of the orders and exactly when. Okay. So we're going to head over and use that particular stock because I think that it is easily best understood. So the first order we're going to talk about is what's known as a limit order. So here's the key. You generally place a limit order, which means that you are advertising to buy or sell. Now, everybody knows the 20-period moving average is a common moving average that most people use on charts. And let's say the stock Roku is all the way up here at 361. And you say, you know what? I only want to get involved when Roku gets down towards the 20-period moving average. At that time, that's when I'm going to look to place my buy order. So that means you are going to place a limit order to buy. You're going to advertise out to the market to buy that stock. And let's say, for argument's sake, the price of Roku in the moving average is $332. So while it's up here at 360, you actually place your order in the market when the stock gets lower at $332, and you're advertising to buy. So somebody has to sell it to you. Very important distinction there, right? So let's say, for argument's sake, you place the order and you get filled. Now you need to make a decision. I want to sell. And you say, okay, I need to pick a price. So we just used a limit order to buy that stock while the stock was pulling into the price that we wanted. So let's just say, for argument's sake, that you want to sell it back up here for a $40 profit. So from 320 to 360. You say, okay, that's where it sold off last time. That's where sellers did something significant. When it gets back up to that level, that's where I want to sell. That's my profit target. The reasons don't matter. We're just going to use this example. So let's say on this day here, Roku starts to rally and you're like, oh, this is great. I know I want to sell at 360. Even before the price gets up there, you can place your limit order at 360, advertise to sell at this point. And as price moves higher, and it goes through 360. Now that means active buyers are taking stock and your stock happens to be there. So you'll sell, they'll buy, you'll be out of the trade, and they look for a new trade. Now we're going to actually look at a different situation. Now we're going to say, what happens if I want to buy when it gets up to 360? So let's say the stock pulls back and you say, okay, that's a big level. I want it to be moving in my favor first. And let's say it's right over here around 345. You could now place a stop order, which up here at 360, you say, when the price gets up to 360, I want you to buy me 100 shares of Roku. So that means that price has to trade up to 360. That's the stop price. Okay, that means trigger my buy order when it gets up to 360. Now you have two different choices when you place your stop order. It can be a market order or a stop limit order. So a market order means that when the price hits, It goes out to the market and gets the best available price. So you're not actually saying, get me this price. You're saying, send the order when it gets to this price and then go find me the best price available. That's a market order. A limit order says if it gets to that price and you put in your limit order, you can't get worse than that price. The only downside is that when you put a limit on the price you'll take, there's a chance if it moves quickly, or if there isn't a lot of liquidity, meaning there's not a lot of shares being traded on a regular basis, there's a chance that you might miss the trade. So most people use a stop market order until they get more experienced and understand how to use a limit order. So I'm just going to recap that one more time. Let's say you want to buy Roku up here at 360. So you place your buy stop order up there at 360 and you choose a buy stop market order. So when it gets up to 360, it triggers your order and then fires off and goes to buy stock at the market. Now that might sound confusing, but think about it. You're already using stop orders all day long, and I'm going to tell you why. See, most people know a stop order based on, let's say you bought stock, and we use Roku again as an example. Let's say you bought it at 360 and the stock starts to go down. And you say, okay, I know where I want to get out, so I'm going to put my stop loss order in there. So think about that, the word stop. You're already using stop orders, but you're using them to get out of a trade when it gets down to that price. So if you bought Roku at 360 and you say, I want to get out when it gets down to 355, just as an example. So it's up at 360 and you have your stop loss in at the market and it goes down to 355. It triggers at that price and now that's your sell stop. So a stop loss order is actually a sell stop order. We just call it a stop loss because most of us are getting out of a position that we bought. So the buy stop order is the same exact type trade, except you're using it when it goes up to a price to get into a position because it's already moving in your favor. So we have the market order, which you send that order out and it gets any available price. You have the limit order where you place the order to buy or sell and you can't get worse than that price. You have the buy stop order, which is if it goes up to that price. You have a sell stop order, which again, you probably know that as a stop loss. When it goes down to that price, your order goes out to the market. So just to clear it up a little bit more, so it's 100% clear. When it goes up to a price, it's a buy stop order. Then you have the choice when you place your order in your brokerage, it could be a stop market order, which means just get me out or just get me in. In this case, just get me in, right, for a buy stop. If you use a buy stop limit order, it goes up to that price and you have to put in the price, the worst price that you'll get. And if you trade stocks with liquidity, meaning a lot of shares traded per day, and my minimum per day is 2 million shares on average. That's just what I use. There's usually plenty of shares around. I typically personally use stop limit orders probably 90% of the time, depending on how fast the stock is moving. So again, just want to clear it up one more time so it's super clear for you. A limit order is you're advertising to buy or you're advertising to sell. So you're out in the market and you say, I want to buy 100 shares of Apple. So you now go out to the market and you advertise to buy based on whatever you look at. So somebody has to sell that to you. Somebody sold it to you, you bought that stock. Now, if it moves against you, you put in your stop loss order. If it moves up in your favor, you put a limit order up there. So it has to trade up to that limit. So you're advertising to sell. So that's if you buy at a limit price. If you want to buy as it's moving in your favor, which is something I do quite a bit, I have orders in the market where I say, okay, that looks great. It has really good order flow. And if it gets up to that price, that's a pretty big breakout level. So I'll have my buy stop order up there. And I'll say, okay, just when it gets up there, get me some shares and let's get into that trade. So it could be trading here at 20 and I might have the buy stop order at 22. So I just put the order up there. When it gets up there, hopefully if I pick the right spot, it takes off and I get into the trade. One of the biggest benefits of that is that I could be trading other stocks. I could be looking at other stocks, but I really love that price. So if it gets up to that price, I have my order in, I get the order, execution comes back, and now I'm in the trade, and now I decide how I want to manage that position. So we're just going to cover it one more time. A limit order is you're advertising to buy or you're advertising to sell. You can't get worse than that price. Somebody has to sell it to you or buy it from you, right? A market order is you just saying, okay, and a buy market order is, okay, I'm going to buy, get me any price that's available. And there's so many different destinations. Typically, you'll get a pretty decent price. Again, depending on how liquid the stock is, how many shares are at each level. So that's a market order. Just go get me shares or go get me out of these shares, right? Then we have the buy stop order, which is if it goes up there, you place an order, and that's either a market order or a limit order. Remember, market is just go get me any price. Limit order is get me that specific price. And if it's going down and you bought, you already know how to do it. You place your stop loss order. So a stop loss is technically a sell stop order. And you have the choice of, do I want to have a sell stop that's a market order? Just get me out of this trade. I can't wait to get out. It's going against me. Or get me out now. I want to lock in my profit. Or it's moving orderly and you place a stop limit order as it's going down. And with liquidity, you should be able to get out with no problem. So the big thing is a limit order is your advertising, for the most part. You can actually place a limit order where you're buying somebody else's shares at a limit order, but that's a little bit more advanced. Keeping it simple, limit order is an advertisement to buy or the best price you'll buy, but not worse. Market order is go get it for me. A stop order is it has to trade up or down to that price. And within the stop order, when you look in your brokerage, it's either a market as a stop order or a limit as a stop order. There's a lot to cover here, right? But let me tell you something. These are the necessary required tools, required skills, required knowledge for you to really step up your game. When you understand that you have so many more different options for placing trades, and that's not complicated. It's just, do I want to place a limit order or a market order? That's it. Do I want to place a stop order? Do I want it to get up to that price or do I want to advertise when it gets to that price? It's really that simple. This is critical because a whole new world of trading opens up to you when you understand just different types of orders that are available to you. It's pretty cool stuff when you really dig into it. So if you have any questions about this, definitely leave a comment below the video. I'd love to hear from you. Go into your brokerage platform. You actually have plenty of options in there and you'll see it's really not that complicated. It's limit, market, or a stop order. That's it. All right. And the different examples of how to use that we used in the chart here on Roku. Definitely leave me a comment if you have any questions. If you found this video helpful, I'd absolutely really appreciate it if you can click subscribe. That would be awesome. Have a great day, everyone.